Hi everyone, it's your daily 10-minute business and finance news wrap for this Thursday, the 14th of July 2022. Later, is taking a holiday to Europe or the United States more value? We'll explain in a few moments. But first to the unemployment rate, which fell from 3.9% to 3.5% in June. That is the lowest since 1974, with implication for wages and interest rates. For more, I spoke earlier with Carlos Cacho from Jarden Group. So, Carlos, 3.5% unemployment rate. That's a huge result. To what extent did it surprise and why?
Yeah, Ricardo, it's absolutely phenomenal result for the labour market. It definitely surprised expectations across the board in terms of the strength of jobs growth, almost 90,000 jobs added, a lot of them full-time, but also their continued rise in participation, which is now at record levels. So not only are we seeing more jobs, but we're seeing more and more people being pulled into the labour market than ever before.
The jobs growth, is it widespread, for example, among age, sex, location?
Yeah, generally speaking, it's been pretty broad-based across the board. In terms of geography, it's been strongest in the eastern states recently, but that's largely, I think, because we're seeing that bounce back from COVID. Obviously, they had more severe lockdowns last year, but unemployment rates are around record lows for most of the states. And it's been pretty broad-based across demographics. But a couple of key themes we have seen emerge have been the continued growth in participation of females in the workforce, and also more younger and older workers staying, more younger workers entering the workforce and more older workers working for longer. So that's a few of the themes, but it's generally been very broad-based strength across pretty much any measure you look at.
An interesting statistic I saw from the release today, there is now one unemployed person for every available job being advertised. So what are the implications of this, and will it lead to wage rises?
Look, if it doesn't lead to wage rises, I think something's either wrong with the economy or the data. It absolutely should lead to wage rises. Every indicator we're looking at is telling us the labour market is very tight, and that we should be seeing wages pick up. Anecdotally, we're certainly hearing evidence of that from companies. I spoke to one corporate yesterday who told me last year they conducted 4 pay reviews to just keep up with competition instead of the usual one that they might conduct annually. So I think we're definitely seeing it on the corporate side. The question is going to be when it starts flowing through to the ABS data, and we do expect over the next 6 to 12 months, we're going to see wages pick up quite materially.
So with wages starting to pick up, the unemployment rate at historic lows, inflation's very, very strong. What does this all say about the economy, this low unemployment rate? And does it now mean more aggressive interest rate rises by the Reserve Bank?
Look, for the economy, it's telling us that the economy remains very strong. The labour market is as healthy as we've seen it in 50 years. Despite the concerns on the outlook and the recent deterioration in sentiment, clearly things are still chugging along very well. I think for the RBA, it's going to give them more confidence in their path of more aggressive and faster rate hikes. Our view has been for a while that we'd see a 50 basis point hike in August with a risk of 75 if we see inflation surprise to the upside. I think today's data is just going to, would support a larger move like that if we do see another upward surprise on inflation. Because clearly the labour market is humming along, and that's not a reason for them to be holding back.
So the strength of the labour market, will it potentially help shield Australia from the threat of a recession amid higher interest rates and inflation?
Well, it definitely goes a long way, the strong starting point in supporting the economy. We think that unemployment rate is going to be the most important factor in terms of how bad or how severe a potential downturn or recession will be. If most people remain employed, that means they're going to be more willing to draw down those savings and buffers that we've been hearing the RBA talk about, and that we've heard that households have built up. If more people stay employed, they're going to be more willing to kind of continue spending, even in the face of higher inflation and a potentially deteriorating outlook. So we think that's really important. And it certainly means that even if the economy is going into a softer patch, the starting point is much better. And so whenever we come out of that, the end point for the economy should be better as well, because we're starting from such a position of strength.
And finally, to what extent is COVID having an impact on hours worked and productivity?
Look, it's clearly having a very large impact. There were almost 800,000 people who worked less because of illness in the month of June. That's around a record high in line with what we saw in May. It's also potentially having an impact on employment. You know, we're hearing from firms that they're having to hire extra workers just to ensure against, you know, people not being able to work because of illness or COVID isolation. I spoke to one large retailer earlier this week who said that they're having about 5% of their stores closed on any given week just because of a shortage of staff. So it's definitely driving a weaker hours, but also stronger employment. And that's going to be weighing on productivity as well.
That is Carlos Cacho there from Jarden Group. Now, Australia's unemployment number wasn't the only piece of economic data to come out today. We also saw the US inflation rate hit a 41-year high of 9.1% annually. It had an impact on the currency markets, with the Australian dollar falling to a 2-year low. There were also implications for the euro, which we'll tell you about in a moment. And that means for travellers, some news there. For more, I spoke earlier with Jarek Kowcza from St. George. First of all, the US inflation numbers overnight, a 41-year high annually. Just how much of a shock was it?
Yes, that's right, Ricardo. We did see a very strong US inflation report last night. As you mentioned, it was over a 40-year high of 9.1% over the year to June. So this was stronger than was expected by economists. And it's also stronger than the number that we saw in the last month as well. So it's up on the 8.6% outcome for May, and stronger than what was expected by economists, which was 8.8%. When we look at the individual components within the inflation report, we did see that pretty much every major component increased. So energy was the major driver of this inflation increase. We saw that surging petrol prices have contributed to very large increases in energy. And in fact, energy accounted for almost 50% of the monthly gain that we saw in June. But on top of that, other components increased as well, such as housing, food and beverage prices, and also other transportation costs. And importantly, core inflation was also stronger than expected. So core inflation is a measure that economists look at very closely, and it strips out some of the more volatile components such as food and energy prices. And that provides a better measure of underlying price pressures that exist within the economy. Now, we did see that come in stronger than expected, but an encouraging sign is that core inflation has actually been decreasing over the past few months, and it's now a bit lower than the peak that we saw in March. So this is a bit of an encouraging sign that inflationary pressures are at least perhaps starting to reduce a little bit in the US economy.
Can we now talk about the implication of US interest rates, inflation, and that on the currency, right? Because the greenback has been strengthening for a number of reasons. This CPI read saw the euro reach parity or fall to parity with the US. What's the story there? Because even though it's a US dollar story, it's also a weakening euro story, isn't it?
That's right. We have seen the US dollar perform extremely strongly over recent months. And when thinking about currencies, it's important to sort of consider what are some of the underlying factors that drive currency movements. So some of the most important factors are what's referred to as interest rate differentials. So the difference between interest rates in one country and another country. On top of that, investor risk sentiment or risk appetite, and also the growth prospects for that particular economy relative to other economies. So we've seen over recent months that the US dollar has really benefited from an environment of increased risk aversion as central banks are aggressively increasing interest rates to get on top of these inflationary pressures. And that's meant that investors are starting to become concerned about what that might mean for global growth prospects, and currencies such as the Australian dollar, which generally benefit when global growth is doing well, have actually therefore seen their values come under pressure. On top of that, as the US central bank is aggressively increasing interest rates to address these inflationary pressures, we have seen that the The relative differences of interest rates in the US relative to other countries has increased, and that's placed upward pressure on the US dollar as well. Now, looking to the Euro region, some of the opposite effects are happening there. We've seen that the Euro has fallen to around a 20-year low relative to the US dollar. And as you mentioned, it recently hit parity. And we've seen that the Euro area has been strongly impacted by the war in Ukraine and the spike in energy prices, particularly oil and gas. So this has really hit European economic growth and the European region. Additionally, the European Central Bank is not expected to increase interest rates as aggressively as the Fed or as other major global central banks. So these factors are weighing on the euro, given that the economic growth outlook is a bit weak and those interest rate differentials are also lower. And those factors are basically what you're seeing the result of that, with a very weak euro and a strong dollar.
Okay, let's talk about what it means for the average person, though, because a lot of that is top level for investors. From a local currency perspective, it means that the Australian dollar is at a 2-year low against the US, but a 5-year high against the euro. So what are the implications there?
That's right. So for the average person, I guess the way that they would see this affect them is through the price of goods and services that you see in the domestic economy. So Australia, we import a very large amount of the goods in our economy, particularly manufactured goods or things like fuel. So as the Australian dollar weakens relative to the US dollar and relative to currencies of countries which we trade with very closely, that does put upward pressure on the price of goods that we import into the country. Now, on the flip side, that actually helps exporters, such as tourism businesses or other businesses that are exporting products, because it makes their products relatively cheaper than their competitors. So it does have a good effect and a bad effect, but for consumers, you're likely to see that being reflected in petrol prices being more elevated than they otherwise would if the Australian dollar was higher, or in consumer goods such as electronics, clothes, TVs, furniture, those sorts of things which we typically import from other countries. Those prices are likely to be more elevated. On top of that, international holidays, of course, become more expensive when the Aussie dollar falls in price, falls in value. But as you mentioned, it's actually strengthened against the euro. So in some ways, this makes a European holiday relatively more attractive than a holiday, say, to the US. So there is a bit of a silver lining there. But of course, it is always a complicated picture. And while there are some people that benefit, there are others that face pressure when the currency devalues.
Jarek Kowcza there from St. George. Now, what did the investors think about the economic drops we saw today? The 200 rose 0.4%, the S&P ASX 200 to 6,650. For more, I spoke earlier with Angus Geddes from Fat Profits.
Well, we had a slightly weaker open after the quite strong US inflation numbers. The market picked up a lot of steam in the afternoon on the back of the very strong labour employment numbers.
The CPI response, though, was muted in the US. Why?
Look, I think the market was looking through those very strong numbers to the June print that will be coming out in about 4 weeks' time. And of course, we've had this big pullback in commodity prices. Oil, gasoline have all pulled back since June. So that's probably going to be reflected in a softer US CPI for June.
One thing that I noticed in your Fat Profits note earlier this morning is that you singled out the US data showed a 34% surge in airline fares, right? And that the fact that seat demand is still strong despite that. So what does that say about the consumer and the potential to meet or cope with higher interest rates, particularly in the US?
Look, the US consumer is very robust. You know, they've got very strong household balance sheets, a lot of cash, liquidity tucked away in bank accounts. So, you know, they've got the ability to keep spending for quite some time. We certainly saw that coming through with some of those airline results where there's been very strong demand, you know, throughout the economy. It should be noted, though, with the airlines that there has been a lot of capacity that's been removed from the market.
Recession, though, some people are still talking about it in the US anyway. Is that on the cards?
I certainly don't think so for 2022. Given the consumer, the corporate balance sheets are just so strong, but we can't rule out an economic downturn in 2023.
And while we had all this local data, the US data today, we're already looking forward to tomorrow. The big one's the Chinese GDP data. How is that likely to play into trade, and what is it likely to say about our relationship with China?
Look, it's an important number for Australia because the market's looking for a pickup in GDP, certainly for GDP to have bottomed out in terms of growth. And, that's going to impact the commodity markets, which is a direct link through to us. So, iron ore, copper, the likes of those base metals and commodities will take a lead from those Chinese GDP numbers tomorrow.
Angus Geddes there from Fat Profits. This SBS on the Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decisions.